Good afternoon. Welcome to the Delta Data webinar that is a follow-up to our CIT survey. The CIT survey was conducted over the last 3 months, and we surveyed industry professionals that are focused on CITs and other products and asked them a plethora of questions about the business of CITs, operational and compliance questions, as well as some open-ended questions around their thoughts of where it was going. Once we aggregated all that feedback, we put together a white paper, but more importantly, we have an esteemed group of industry experts who are going to comment on the findings of the survey today. We really look forward to the insights that they're going to be providing. And please, if you have questions, feel free to put them into the chat box, or in our question and answer session at the end. You're welcome to ask them by just raising your hand on the Zoom. I'd like to introduce the members of our panel today. Gail Weiss is from Aon, and she's worked with us previously on gaining understanding of this market. She truly is a thought leader in the industry. Gail, you want to introduce yourself?
Sure. Thank you, Whit. My name is Gail Weiss, and I'm the Global Chief Operating Officer of Aon Investments. And part of my responsibility includes oversight of Aon Trust Company, where we primarily focus on our efforts to support our investment advisory business, as well as we have a family of collective investment trusts that we sponsor through that avenue. And collective investment trusts are near and dear to my heart, as many of you know, because I'm actually pursuing a PhD in the governance of CIT. So this is something that makes me very happy to discuss every day. So happy to be here. Thank you, Whit.
Thanks for joining us, Gail. Our second panelist is Alan Dunaway. Alan, I think you actually started work on these right out of college. You might be the longest tenured person I know in the industry, so I'm sure you've seen it all. He's works with FIS. Very happy to have you on today. Can you tell us a little bit about yourself?
Yeah. Thank you, Whit. And I'm honored to be included on the panel today. I'm a senior vice president with Reliance Trust Company, which is a wholly owned subsidiary of Fidelity National Information Systems, or FIS. Reliance has been around for a little over 40 years and are firmly planted in the collective investment space as well. We currently run about 140, 145 collectives with 30 or 32 different sub-advisory relationships with firms out there, and a little over 60 billion in assets. And yes, I have been in the industry since about 1985, working with collectives, and I've seen the pendulum swing back and forth, and I'm happy to say that it's on the rise, and we're very excited. So thanks for having me.
Thanks, Alan. Our next panelist, Laura Lutton, she works with Morningstar. Morningstar is a dominant provider in the market of research on funds, and has really institutionalized the access to research and data in the 40 Act space, and is now picking up steam in the CIT space. We're very lucky to be able to partner with them on this type of research as well as the webinar. Laura, a little bit about yourself.
Thanks, Whit, and thanks to the whole Delta Data team for including Morningstar today. I'm Laura Lutton. My title at Morningstar is Head of Asset Management Solutions, and I work in our business development group with asset managers on strategic initiatives. One of their big initiatives broadly, I think, is to extend their expertise in a particular vehicle across other vehicle types, including CITs, SMAs, model portfolios. And that's where I spend a lot of my time talking with clients. I've been at Morningstar almost 22 years. Most of my background is in research, and I led the manager research team for North America when we started qualitative research and ratings on collective investment trusts. And as you mentioned, with building out our CIT database and the analytical capabilities that our clients can use with CITs is certainly of central importance at Morningstar. So appreciate being involved in the conversation today.
Thanks, Laura. Our last panelist, Devin McCarthy. Devin comes with a tremendous amount of insight on the data and analytics, because NASDAQ is known for its data and its cutting edge fintech capabilities. With NASDAQ being a part of the CIT push for better access and visibility into things as simple as pricing, I think he brings a unique perspective today. Devin, a little bit about yourself.
Yeah, thanks, Whit, and appreciate being a part of this panel with all the panelists. Yes, Devin McCarthy. I've been at NASDAQ for 11 years. I've been on the information services side for the entirety of my time here. I run the sales and partnership effort for the NASDAQ Fund Network, and took this role about 2 years ago, right when we got into the collective investment trust space. So compared to the knowledge here on the panel, I'm probably the I don't have as much experience as everyone else, but we have definitely a lot of great feedback from the current issuers of collective investment trusts on the platform, both from the trust side and the asset management side, and just pleased to be here with everyone today. So thanks for having me, Whit.
Thanks, Devin. One of the things that I find interesting about the panelists and about the number of people who responded to this survey, there's a growing interest in the market for CITs, and there is a definite response from the major providers like NASDAQ and Morningstar. FIS, one of the largest bank servicing institution. That type of focus, and then you have folks like Gail. Aon's definitely a historical player in the space, but Gail mentioning getting a PhD. There's a lot of focus right now from some very big firms and some powerful minds out there to push this product where everybody feels it can go, which is even steeper on the growth curve than we have seen over the past decade. When we did this survey, we did reach out to over 160 individuals. I can tell you that all 160 we know are in the CIT business. We received responses from about a fifth of them. Interestingly, the ones we received a response from were complete. Start to finish, lots of commentary. And the most active were the bank sponsors in the survey, and asset managers were second with about a third of the respondents. We did receive some additional information from the other service providers as well as the plan consultants, but it was not, although insightful, it was not mathematically significant. So we have put all the stuff that's in this deck in the white paper. What we're going to talk about today is mainly around the bank sponsor and asset manager responses. What did y'all think about when you looked at the detail that came through on the white paper? And Gail, you made some interesting comments right out of the gate on, given how many people responded, it's still not a lot of data out there for us to get our arms around to understand exactly where this market's going relative to its peer markets that are much easier to track. And Morningstar did provide some great data on exactly where they felt the market was year on year. But just right out of the gate, what was the panel's thoughts on the growth curve to date, and how does 21 look similar to or different than the last decade?
But I'm happy to share my perspective on where this is going and why I think that the growth is understated. And I look at it from the standpoint of, when I look at how banks are regulated, and you can be a federally chartered bank and be regulated that way, or you have 50 different state regulators, that there is no one source of data to go to get a true consolidated picture of the growth of CITs. But we can look anecdotally at things like what Morningstar is seeing, what NASDAQ is seeing, and even when I look at the growth of the number of CITs that are presented on the NSCC for trading, we've seen exponential growth in the CIT market, and we've seen other types of funds decrease. But it is really hard to get a picture of what the true growth is. But I have to say it's got to be understated, because what we typically see when we're looking at whether it's Morningstar, NASDAQ, or NSCC data is it's driven for the daily valued funds, but there's still plenty of other non-daily valued CITs that are out there that typically are used in defined benefit plans that aren't reflected in a lot of these data points. So for me, I see tremendous growth, and it's only getting faster and quicker. That's my opinion.
It's Devin, and I appreciated Gail's perspective there. And I mean, from our perspective at NASDAQ, we've been watching the CIT space over the course of the last few years, and and we'll talk about it a bit later. And you pointed out here in the slide, the growth in the smaller plan market is really where we're seeing it resonate with our customers, especially in that kind of intermediated advisor sold CIT space. Being able to have a ticker symbol to be able to show what that daily price is for a CIT is really a benefit to the advisor community. So we see the CIT space as a great opportunity to broaden distribution, education, and like I said, ensure those advisors and investors and asset managers can have that same transparency into these products.
And I'll support Gail's comments as well, that this data likely understates the number of assets that we see in CITs. Much of CIT disclosure is still voluntary by the investment providers, and Morningstar, and I know other organizations, NASDAQ, work in the trenches to improve that disclosure, but there's still work to be done there to understand not only the breadth of the CIT market, but where the assets are going. I'm not surprised to see that the biggest area of growth in terms of assets is in allocation solutions, because we're seeing that in other investment universes as well. I think the appetite for all-in-one solutions, whether that's in the retirement market or in a taxable account through a traditional model portfolio or managed portfolio, that's very consistent with data that we're seeing across the industry. But again, until we get very comprehensive disclosure, let's assume these numbers are a little smaller than they are in reality. But I think there's a lot of incentive for firms to disclose, because advisors and other market participants really want to be able to compare these investment types with others, and they need good data to be able to do that.
Laura, you bring up an interesting point. Y'all have great data that you shared with us and to this panel. And you make a great point on the fact that until there's standardization on disclosures, all of the research and all of the viewpoints are based on a data set that is smaller, and that if it's going to go and compete head to head on the advisor desktop, the expectation is what they're used to, which is this mutual fund performance is X relative to the market, and the market being the entire market. And right now, I think what I'm hearing all the panelists say is this is a percentage. It's a mathematically big enough percentage of the market, but it's still not at all the whole market. There's large swaths of assets that go unreported, and that all of the value propositions that we can deliver to our end clients will only improve as the disclosure gets more transparent. When we look at the different levers that we saw driving growth that came through on this survey, Devin, you mentioned that it definitely appears that they're pushing down market. And I appreciate you bringing that up. What are y'all's thoughts around the down market and where we are in the race to the down market?
Yeah, I would just from my perspective, and since we launched this about 2 years ago, that down market is really where we're seeing the demand for symbols and daily price performance. Especially, I think you briefly hit on it earlier, Whit, where as these come down market and they go into more of the advisor intermediated sold space, that's the space where we really see that a benefit of a ticker is really resonating, especially amongst the advisor community who may be used to, recommending mutual funds. Maybe they understand CITs, but just have never really had that additional price transparency and distribution at the advisor sold level. So if that advisor can then be able to look up, a specific CIT wrapper, and they're used to recommending that mutual fund wrapper, but now they can search a 6-character ticker symbol for the CIT wrapper. That really is a validation point for CITs amongst the advisor sold space. So we do see demand at the larger plan size level, especially over the course of the last few months. But I would say really where it's resonating is that advisor sold intermediated space, that's where we see a majority of the growth right now for us.
This is Gail. From my perspective, we look at it and we've been typically in the large plan or even the mega plan, and we'll even do a custom CIT for the very, very large plans, but we see it as an untapped opportunity for us to go down market. And so we are absolutely looking at how we can get better placed among those smaller plans and start, being able to distribute our CITs that way. So it's definitely something we're looking at.
Yeah, and Woodfield, I would echo Gail's comments and Devin's as well. We have had institutional relationships as well. Some where we've created collectives specifically for a certain situation or two where an R4 or R5 share class may still be too expensive, and we've been able to create call it a clone collective for clients. But as you look at those opportunities, they are few and farther between, and the downsized or downstream marketplace is where, it's growing organically every payroll period, and so it's definitely where the market is moving. There's product that's being developed that will serve that segment of the marketplace. There's a need for transparency. There's fee considerations that are all moving in this direction, and those that want to remain competitive, in this space are looking at CIT. So we see it as being a very much a growth opportunity in need of some standardization, which I think is going to be the theme here probably this afternoon, and also technology. It's a different model. The institutional model, we call that a low volume type model, which is very easy. And I think Gail would, agree that it's easy to service that side of the marketplace. But this is a high volume, downstream DC place is a high volume, high transaction market, and we're going to need that standardization.
I think when we look back at, the CIT market, I think years from now, we'll look at the ticker symbol event as really a pivotal point at which CITs go mainstream and become more acceptable to plans of all sizes, because it just creates transparency and accountability that has certainly been there for firms that have been focused on providing that, but has not been as widespread as it will be in the years to come as more CITs adopt the ticker and make their disclosure more uniform and frequent and accessible to all investors.
Whether you're selling software or you're building out an industry around CITs, as the product standardizes and gains scale, it cuts down on the expense of bespoke solutions for very large clients. So I think that the cost to operate in the down market, once that scale has been achieved, will be more manageable than when you're dealing with multi-billion-dollar single accounts that have a lot of bespoke paperwork around them, bespoke operational processes around them. But to Laura's point, the building blocks had to be in place. If we were going to go after a scale play like Alan says he's seeing in the market, you got to have the building blocks like a searchable ticker to provide that confidence and that transparency, so that the much larger intermediary advisor sold market that Devin was pointing to has the visibility that this product's out there mainstream and they can invest in it or invest their clients' funds in it with confidence. There's been some interesting SEC action in the last year. We put some commentary on this slide that came out of the survey, but Gail, you had a really interesting viewpoint on the reality of the Great Plains case and what that could or couldn't mean. Granted, nobody has a crystal ball to figure out what the SEC is really going to be interested in 2022, the end of 21 and 22. But this Great Plains actions case was definitely an outlier where we saw the SEC getting involved.
My understanding of what occurred in the situation at Great Plains was that the bank provided some investment direction to a sub-advisor. The sub-advisor was an affiliate, but in this case, they work closely together. The advisor did not follow the direction of the bank, and the bank failed to do anything. And that's where I think there's going to be a tremendous amount of really digging into how these CITs are governed and making sure that they maintain a very clear direction that these are bank-sponsored funds and that the bank is driving the investments. Even if you employ a sub-advisor, and we employ many sub-advisors for our CITs, we absolutely do it, but we have to make sure that we have the proper oversight and we have the proper reviews, and we look at it very closely to make sure that there is no doubt about it that the bank maintains that control. And so that, I think, is something that, as you look at the different types of, when I look at CITs, I look at them and say there are really three categories. There's the traditional bank trust department with a full asset management team, and they know how to keep a bank-sponsored fund because they've been doing that all along. Then you have asset management firms that have created trust companies to help support their CIT initiatives. That's a different animal, and they look at oversight differently because of their roots when you look at them from the mutual fund world. And then you have those banks that are there to help facilitate the launch of CITs by being friendly and working with lots of sub-advisors. They have a different approach. So I think that this oversight component is something that will be very important moving forward. And I think people will be putting in enhanced procedures and policies to make sure that we keep these very much bank-sponsored and keep the SEC at arm's length and deal with the bank regulators.
This is Alan. I would absolutely agree with everything Gail has just put forth here. This is probably an inflection point. It is, as I recall, it's the first time the SEC has stepped in a case like this in almost 40 years. And I was around basically when they gave their last opinion on the collective world, and they said, listen, don't ask us any more questions. This was probably back in the 1980s. Don't ask any more questions because we're done. Well, at the time, CITs were going out of style. The banks were moving to 40 Act funds because they could serve a larger audience. They were not investing in technology. They were very slow to do so, and in essence, the fund companies disintermediated the entire retirement business away from the banks because they weren't willing to get into the technology to spend on the technology to get them to daily valuation. So the SEC was not interested. Now all of a sudden the pendulum again has swung back the other way, and there's some interest, and they may feel that there's some regulatory bodies out there that are not doing their job. So it is going to be interesting to see how those three categories of trust banks and trust companies respond to what's happened and how they are going to run their oversight programs.
Speaking of Washington, we mentioned it once or twice so far, but it sure seems that we're at an imminent point of a decision for allowance of 403B plans to invest in CITs. This is clearly going to affect the industry. What are y'all's thoughts on this pending legislation or registration exemption announcement from the regulatory bodies? I'm going to guess that it's everybody agrees this is going to drive an uptick in volume and the alignment of the lower cost CIT chassis with with the needs of large plans, especially union-based plans, seems like it's a good fit both on meeting goals as well as seems like a good fit as a product for them. Anybody want to pontificate on the uptake of the 403B market? Do you think this is a 2-year push into that market, or do you think that it's a slower pace whereby it'll take 4 or 5 years for this space to see significant market penetration or flip from our share class funds into CIT equivalents?
This is Gail again, and I look at it and say it's a natural, they should be in a lower cost product, but what is the uptake? Who are the current providers of those investments today? And why would they not want to release those assets and put them in CITs? So I think we're going to have some headwind there. But then we also have to look at what is the time it takes to actually change out a fund in a 401k plan today. You've got the whole planning and you've got the communication and all of that. I think we're still going to have that type of headwind that we're going to face with the 403B market. So is it a year or two? My guess is it's probably a little longer, but we need to make sure that those 403B providers today, are looking at it from the appropriate lens of it's the right thing to do for the underlying investor as opposed to what might be a more expensive product today.
And I would agree with that, with Phil. And I think that to help prompt some of that thought process, maybe some of the litigation firms that are trolling around out there right now, filing, excessive fee suits and self-dealing suits. So I think that once that settles in a little bit, that might be a bit of a catalyst.
I think also y'all hit on some points in the 403B space that I think also tie into future regulatory environments. I believe that the industry is moving in the right direction for transparency, but if you look back to, say, Obama era fiduciary rule focus, a lot of it was around ERISA, advisor sold ERISA business as being absolutely under the fiduciary rule. My point is with the current administration likely having those leanings, anything touching ERISA as well as the 403B market, which has teachers unions involved, I think it's going to have increased, not decreased, regulatory oversight going forward. So to Gail's point, great time to have the right oversight program in place to give those plans the confidence as soon as it's available to move into this product set. Gail, you had mentioned there's an inherent difference or perspective you have to take with asset managers and bank sponsors and all the responses in this survey. And if you look at the data, it sure shows that asset managers are more willing to play down market sooner and a larger number of them are willing to play in the smaller market today. Could you give us a little bit of insight as to why historically?
So the way I look at this question is that from the bank trust department perspective, we typically haven't been serving the retail investor, whereas the asset managers have built out an infrastructure to support the retail investor. So they have relationships with large transfer agencies and they're used to, in their mindset, what it takes to do a daily nav, how to push it out there and make that operationally efficient. Oftentimes the banks don't have those kinds of relationships with the big transfer agency firms. They might be running, a small transfer agency operation within their own bank, certainly not nearly as robust as to handle thousands and thousands and thousands of investors. So I think the perspective that they come from and that historical is really what drives it. So it's natural when I look at the bank sponsor side to say, well, they don't want to come down market because they're really not built operationally to support that. Whereas the asset managers, every day they're working in that retail space so they can. So to me, that's reflected here in the findings of the survey.
What do you see in that more institutional B2B historical mindset of bank sponsors versus the more retail oriented asset managers? Do you think that that is playing into how they see the market and how far down market they're willing to go?
I do definitely see that, because it's even little nuances, things like the bank as the sponsor of the CIT, but also as the trustee of the 401k plan. They don't need to trade that fund on the NSCC, so they haven't built out that type of infrastructure to support it. So I think that as the banks are looking at this, if they want to go down market, they have to look at how they can deliver for a broader range of constituents. And that means, how do they make those funds available so that it's attractive to the various kinds of record keepers out there? How do they get the information about their funds out there to the investment advisors that may be selecting? So it is a different mindset, and it's going to take some investment in time and energy to make that happen.
Yeah, Whitfield, and I would definitely concur with Gail there. Historically, again, when you go back, balanced forward plans, defined benefit plans, the bank was the CIT. They were they ran the CIT. They were the trustee. They were the asset manager. They did the administration on the balanced forward work that had to be done on an annual basis. Probably the only thing they didn't do was the actuarial work, and that really was not a part of this discussion. That's just that's a separate function. And they got disintermediated. They did not invest in the technology that it was going to take to get them to a daily environment, and they missed it. And so, to Gail's point, there's more of an institutional mentality there. Maybe they don't have that connectivity to the record keeping platforms, to the trading platforms, the transfer agency work that needs to go on there. But that is the downstream market. That's the segment of the market that's growing. And so the only way you're going to solve that problem, to your point, is through technology. You've got to be able to onboard these high volume, high transaction, multiple transaction types of accounts and products that are being developed, because again, that's where the market is growing. So if you're going to stay relevant, that's what you're going to have to do. And hopefully the banks won't make that same mistake once again and ignore, the signals that the market is giving it where it wants to go.
Laura, Devin, you guys have a preponderance of capabilities for a lot of asset classes, and you've talked about your building out the services provided around CITs. Can y'all talk a little bit about the types of services y'all are building out and how it helps market participants get after this down market that kind of is really coming through in the data as their, a stated interest for the industry?
Sure, I'd say a couple of things. First of all, it's our goal to create the same kind of transparency for a CIT that we would have for an open-end mutual fund. So the same sorts of analytics in terms of peer group comparisons, being able to measure long-term returns against a benchmark, compare fees. That's our goal for the CIT universe, as well as other, non-registered or traditionally non-registered securities. And, part of our interest there is Morningstar does have very deep relationships with those retail asset managers that Gail mentioned, that are very interested in capturing as much of a client's investable wallet share as possible. And they want to be able to, provide very comprehensive whole investable portfolio analytics for that client, whether they have their retirement assets in a CIT, whether they have a taxable brokerage account where they also have investments. They want that to be a seamless display of data and be able to show the client whether they're on track to meet their financial goals. And so it's our interest here to help facilitate that through the data foundation, as well as the analytics, both quantitative and qualitative.
Do you see any difference in the types of questions coming from the bank sponsors to your group or the asset managers, or generally, is it the same set of questions, just slightly different historical perspective?
This down market is really where we see a demand for trust companies and asset managers alike, specifically amongst that smaller to medium-sized plan, especially in that kind of the CITs that are shared across different plans in the target date space. What NASDAQ has built over the course of the last few decades, as far as a network and plumbing through the financial services, you can be able to look up a CIT that ticker symbol and price information on most applications that you're able to look up mutual fund pricing by typing in a ticker symbol. So as these, as the market goes downstream into the smaller to medium sized plan, that's where these advisors are really looking, leveraging multiple different applications to be able to do their research and due diligence across different funds, and being able to look up that ticker symbol in the same fashion and that same user experience that he or she is used to on the mutual fund side is really resonating from a technology perspective.
And I'll just add, Morningstar does fact sheets for plan participants who are have CITs available, and that service is very scalable for providers. And in general, I would say that those types of reports are an easy way for firms to incorporate their data and make that broadly available to a handful of participants or thousands of them. One of the areas where we're working with CIT providers is on those fact sheets and some of the deliverables that go along with explaining to plan participants, what are the attributes of a particular CIT, and that's a pretty standard ask, regardless of whether it's bank, trust, or asset manager sponsored. But I would say, to Gail's point earlier about the elegance of the plumbing in terms of striking daily prices and having relationships with all the market players that are required to be efficient in this space, like the asset managers certainly have an edge there.
Laura, we appreciate Morningstar providing this data, and this data is for use in this webinar. But I thought what was most interesting that came out of this was the growth that we've seen really over the last 3 years, 3 to 4 years, is here in the allocation models. Could you talk a little bit about the allocation model CITs and how they are appearing to take some of the market share within CITs out of straight U.S. equity, but the allocation model as a whole? Love to hear your thoughts on that.
So I think multi-asset allocation solutions are very popular across the marketplace, especially as we see advisors spending more time on planning with clients and less time on investment selection. And so the fact that we're seeing those trends in the retirement marketplace doesn't surprise me in the least. And I think longer term, this is where we're going to see a lot of growth of assets in general across our industry in these allocation solutions. So this data is consistent with what I would expect given those broader trends.
The next stuff that we're looking at is as people are moving to the down market, we ask them, what are the things that's important over the next year that you guys are really looking at? And again, I think, Gail, you brought interesting perspective as to what bank sponsors are looking at versus asset managers. But what jumped out at you guys looking at the results of these survey questions?
I think from my perspective, this is pretty much in line with what I would have expected, at least from the bank sponsor side. If you're going to move downstream and again into those high volume models, you're going to need to augment and supplement your trust, your service model. You're going to have to automate. There's no way to get the kind of scale that you need by just adding more bodies. So you're going to need technology and again, standardization of information that flows back and forth between all the various service providers that are focused, that are associated with a CIT or a plan sponsor. And then the focus on what maintaining means. That word, maintain the trust, is extremely important. It's what gives you that securities exemption from the SEC, and how you're going to maintain that governance. And given what's happened in the marketplace this past year, that's even more important.
So, that gets into the whole transparency discussion. I'd say the biggest recurring theme in the survey was, how do we get increased transparency? Nobody's saying there's no transparency, but what are y'all's thoughts about the larger number of players per product and its contribution to lack of transparency? And then I think, Alan, you brought up lack of standardization also increasing the lack of transparency, but transparency is a key theme, it seems, for 2021 and 22. What are y'all's viewpoints?
I think when the end client demands the transparency, the players will figure out how to provide it. And I think we're getting close to that point, if we're not already there, in terms of plan participants wanting to have all the latest information in terms of performance and pricing and so forth at their fingertips. But I'm obviously very sympathetic to the complexity around making that happen, given all the parties involved.
I agree with you completely, Laura. And from the standpoint of, we offer our CITs, but then our clients have different record keepers and they have different requests, and that is challenging every month, every quarter, fulfilling all of those different kinds of asks. So standardization would be very beneficial in this market.
So it gets into the counterparty communications in Delta Data's view, and one of the reasons that we host this roundtable, this is one of the few places where multiple large institutions have to coordinate their efforts to deliver a product to the end plan. And we do believe that is at its heart where a lot of the complexity comes from. And then it's exacerbated that it's complexity within a fiduciary environment. So I'm sure none of this is shocking to any of y'all, but is there any data in here that y'all thought was noteworthy and worthy of another look?
This is consistent. I think the results here are consistent with our experiences. And as I said a second ago, you're getting information daily from a variety of different record-keeping organizations. And there's no standardization of reporting. So there's information that you may get from one record keeper that you don't get from the other. That creates stresses and strains on your ability to set the account up and to notify the proper people. And, we work, we're a third party trustee. So we work with asset management organizations as sub-advisors, and they want access to some of this information as well, because they want to know where these accounts are coming from in a geographic perspective, and who they're coming from, who the consultant is, who some of the vendors are, so that they can, better, refine their marketing and sales plans and client servicing plans. And sometimes it's very difficult to do that. So, this is consistent with what we see in the problems that we run across on a daily and weekly basis.
What is the group's thoughts on, clearly it doesn't take 2 weeks for every CIT we approach, but the fact that there is the majority of asset managers and bank sponsors do have trouble coordinating the operational launch, and also onboarding a new plan is challenging for many. Y'all want to talk about, in addition to what y'all already described is a challenging structure between the multiple counterparties, what else might be contributing to this?
I look at this from this just sheer paperwork that needs to be, to be signed and executed to make those contributions into a 401k. I need authorized signers. I need the participation agreement. I need a W-9. I need a whole host of things that I require, and I need to have all of those things in before I will open up an account and let the investors in. And so, if I'm working with a plan sponsor that's got somebody that's laser focused on getting that account opened and building out the relationship, then I can do it in a couple of days. If this is a collateral duty on somebody's desk, and so this is really looking at how the plan sponsor is staffed, It might be that it takes, a week to internally get my authorized signers form signed before it's back to me. So that's the challenge is, what is the focus at the investor level coming in to get the paperwork to me? And I need the paperwork. There's nothing I can do about, I can't let it slide. I have to have all that paperwork in before I'll open up the account. And so I think that that's what leads oftentimes to the 2 weeks plus is just the trying to coordinate, to get that paperwork in.
Alan, it's interesting. There's a chance that some of the technologies that really took off around COVID, like e-signature, could have a material impact on this space. Gail just talked through about how we have a plethora of paperwork to work through, and a lot of it is how interested is the person you're working with to get that paperwork to you. But maybe talk a little bit about how technology could perhaps help this area of current pain.
Yeah, no, and that's a great point, and I completely agree with Gail. It's been our experience that when we are dealing with larger institutional plans that we'll even call them one-offs, there is a person somewhere there that is dedicated, that is shepherding that process, getting those signatures, getting the forms filled out, they're copying the right people. It's almost like a mini project plan that they're working on, and they get it done very quickly. As you move downstream, and as you mentioned, you're dealing with more and more counterparties that are involved in this, and they're different organizations, and they're coming there and they're playing different roles. That's when things begin to come off the rails a bit. And so in terms of the technology and the e-signatures and the ability to move those documents in their entirety through that system, and be able in real time to understand and know where those documents are and have they been executed, who's executed them, and are they moving to the next station down the line, I think is critical in this space, because again, when you're looking at multiple parties that are involved with this, that's when it's very easy to get into the 2 and 3 week time period of getting these documents executed and getting an account set up. So that's the type of technology that, coupled with the standardization, I think is necessary in this in this segment of the marketplace. To make sure that information gets pushed through in a timely fashion and these things get set up in a timely manner. So I think it's critical.
Yeah, I think that the interesting dynamic that we are seeing is the increase in volume required to keep growing our business, and what's likely going to be a less informed consumer that you're pointing out in the down market. At the mega market size, there's a lot more institutional knowledge held at the plan sponsor than in the down market. So that is likely going to get worse before it gets better without the help of technology and, importantly, standardization that the technology can ride upon. So that leads to potential compliance issues. I mean, I don't think that you have to be talking about CITs specifically to say if you're in a high touch, low volume manual execution operating model and you add scale and you reduce the institutional knowledge of what you need on the end client's front, that is a recipe for potential compliance issues without the right oversight. Any thoughts on how we continue to have high compliance to essentially protect the trust, as you pointed out, while achieving this scale through the smaller players in the market?
Yeah, no, I think that that has to be a focal point and central to the overall equation. And not only the onboarding process, but the ongoing operation of a collective, and then in administration and maintenance of it for the benefit of the participating plans. So it does start to slow down. When you think about this, think about who all is involved with this. You could have a consultant on the West Coast. He has a home office on the East Coast, and maybe his record keeper is in the central time zone, and he's got a TPA in the mountain time zone. And so they're spread out, and everybody's busy, and so there's got to be a way to standardize and to put some guardrails up so that this information flows in a very timely manner from one location to the other, and that the people there, they take it out, they do whatever they need to do with it, and they push it forward. In order to meet that definition, we still don't know from a regulatory perspective exactly what that word maintain means. It can mean a lot of things to a lot of people. So we want to button this up and lock it down so that whatever the regulators are looking at, whether they're looking at the investment oversight and maintenance of the funds from that perspective, or they're looking at the administrative and operational side of this, that it runs exactly the way it's supposed to. We want to make sure that we're putting our best foot forward. Is this segment of the market, as this product service grows, I think it's gonna get more and more attention from more and more folks. And so we've got to have the answers for them in advance, so that we're not encouraging additional oversight and regulation. We want to voluntarily do this.
I agree with you, Alan. And one other observation that I have is we have to look at this from the standpoint of, when we give out our CIT documentation, it's not really up for negotiation. If you would ever think that you could, look at a Vanguard, account opening, nobody would ever think about trying to negotiate that. But there's still a mindset that they can come in and try to tweak the agreements, and that we have to stop.
Exactly. I couldn't agree with you more, Gail.
Yeah, Gail, I agree wholeheartedly. And as I had mentioned, that as we go down market, one of the benefit is getting out of bespoke contracts. And that has to do with any business, whether you're selling software or you're selling asset management. The large assets are nice, but they come with a lot of bespoke strings attached. I think as the industry moves into the down market, it's a bit of a chicken and an egg. More standardization, greater scale has got to be found. And I think that will require better standardization and less one-off, either contractual and or sub-advisory execution models.
Some of the original feedback that we were receiving after we first went live back in August of 2019 with registering CITs was there was a reluctance from a compliance perspective across a handful of some of the larger CIT issuers that we're working with right now, and specifically those compliance concerns really centered around the advertising and marketing rules for CITs. And so we were fortunate to be able to work with a law firm out of New York, Evershed Sutherland. And Evershed was able to do quite a bit of research and wrote a white paper that was published in February of last year. And it basically came to the conclusion that ticker symbols, searchable symbols, daily price discovery does not run afoul of any of the marketing and advertising rules. And if anyone that's on the webinar today is interested to receive that white paper, I'd be happy to connect with you offline. But it really addresses some of those compliance concerns. And once we were able to get that paper broadly distributed in the retirement services space, we were able to, since that paper, we've been able to add 10 new issuers to the platform. So hopefully that helps answer your question.
Devin, I think that's a really interesting hurdle to overcome. I have long wondered whether our CIT industry is holding tightly to the no marketing is allowed mantra, which I don't think is all what we read in the rules. But the rules were set back in the 80s, and I think since then the regulatory bodies are definitely pushing for better transparency for anything ERISA, and where we can get better visibility and transparency to the end participants, I think would be A, for their benefit, and B, likely supported by the actual rules that were written many decades ago. But to your point, I think to evolve us from that mindset of you can't market them, it is going to take legal opinion. So hopefully over the next 12 to 24 months, we see further legal opinion on other items like fact sheets and or marketing materials that are sent through correct channels to the correct recipients that perhaps will open up the viewpoint and will also, again, provide better visibility and transparency, which overall will give more growth to this product set. We at Delta Data, when we read through this survey, we tried our hardest to look at this from a business perspective. And when you look at the Delta Data's clients, we historically have approached the large at-scale players. And what we realized is just listening to our clients' quarterly calls that they're all trying to achieve north of 10% growth on their business. To be clear, we put this together just from what we read in the survey and how we saw it come through. If they're trying to achieve 10% business growth, yet they're chasing the down market, which best we can tell from the data, which is hard to get at, is around a 10% reduction in the size plan year on year that they're actually onboarding. We put this little graph together to illustrate that in just a 10-year period, you're having to go after almost 7x the number of plans to achieve that 10% growth. Gail, you talked a good bit about oversight and compliance. When you're talking about the same team and the same processes and the same pain points, yet you're multiplying the scale by 7, it definitely it's pause for concern if you're in charge of the operational compliance of the program.
So what's interesting to me about this slide here is, the number of asset managers that are investing in technology to drive their costs down. And I think that'll, really be an advantage for those firms from a competitive standpoint going forward, because, across the investment industry, smaller accounts tend to be more expensive for firms to service. And I think that they're looking for ways to be more efficient, whether it's, a small 529 account or a, younger worker who's just starting to contribute to their retirement plan through a CIT. But this is a big theme in the industry that I'm hearing about across vehicle types. Asset managers are very anxious to lower their cost, per dollar across their lineup, and they're doing that through investments in technology and the efficiencies that they can leverage as a part of that.
So, I guess, Alan and Gail, y'all operate in this market as you guys have been, part of this trend to push the volume up, maintain, your fiduciary responsibility, as well as deliver a better product each and every year. What are some of the challenges? Talk a bit about how has technology helped to date? I mean, what are some of the things y'all have done in the past that definitely helped get to the scale you're at today?
Well, Whitfield, it's a great question, and it's obviously a work in progress. You come up with a process to do something, and then you realize, hey, there's probably a better way to do this. So obviously, you want to get into document management, automation, and in the other areas where you can automate as much as possible. And this slide is a good slide. And what it doesn't really address is not only is this having an effect on our top line, also has an effect on the bottom line, because again, you're moving from a low volume, low transaction model of institutional business, and that's a segment of the market that is stagnant. It is not growing. You're moving downstream into a high volume, high transaction, lower balance model, but it's growing. It's, as I said earlier, it's growing every week with payroll deductions and matches. And you have to, it requires a more rapid adoption of technology in order to try to maintain not only that top line, but that bottom line. There's pressure on pricing. In the last 10 years, pricing, from a trust perspective, a trustee perspective, has come down dramatically. There are more entrants, more competition, there are more assets, and with assets, people look for pricing discounts and breakpoints. And so you have to factor all of that in. And I think technology is going to be the core solution to a lot of these issues, because you can't just continue hiring bodies when your margins are shrinking and the size of accounts are shrinking, and there's more work that's involved on a day-to-day basis. So this really kind of captures what's going on in the industry. It's a good problem to have because it's because of growth, but it's got to be managed, and we continue to look for solutions.
And I think you've made an interesting point in that, the banks are looking at it from the lens of, we typically go for large institutional clients with low transaction volumes, but high value dollars. But the asset managers are looking at it more from the retail lens. So even though we say we're coming down market in the CITs, from their perspective, retail, $2,500 to open up a position in a mutual fund, they're talking coming down market, but that we're talking $1 million plans to them. So that in essence is almost like going up market from their perspective. So that's why I think that the technology is different.
Excellent point. Excellent point.